Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Friday. This is Peter Lewis with Money Talk for the final time this week on the 17th of May. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business, finance and economic headlines, President Xi Jinping welcomed Russian President Vladimir Putin to Beijing on Thursday as both countries seek to bolster their strategic relationship. They vowed to work together against what they said was destructive and hostile US pressure and to deepen the ties that have sustained Russia's invasion of Ukraine. President Xi said China was ready to work with Russia as a good neighbour, friend and partner with mutual trust. He added that he was prepared to consolidate the friendship between the two peoples for generations to come. Japan's economy contracted in the first quarter as consumer spending notched its longest downward streak since early 2009, raising a challenge for the Bank of Japan's plans to tighten monetary policy. The Japanese economy contracted 2% in the first quarter, compared with economists' forecasts of a 1.5% decline, and after showing no growth in a downwardly revised figure during the previous period. Household spending, which makes up more than half of Japan's GDP, remained weak, falling 0.7% from the previous quarter. The European Commission has launched an investigation into flat-rolled products of iron or steel plated or coated with tin from China to assess whether imports into the European Union are sold at excessively low prices. The Commission, which oversees trade policy in the 27-nation EU, launched the anti-dumping investigation following a complaint from European Steel Association Eurofair. A stream of Fed speakers on Thursday reiterated the higher for longer message on interest rates. New York Fed President John Williams is optimistic that inflation will continue to retreat, although he still lacks the confidence that inflation is moving sustainably to 2% and he doesn't see a need for a near-term rate cut or hike. Loretta Mester, president of the Cleveland Fed, replied it will take longer to gain confidence that inflation is moving towards 2%, but a strong economy means the Fed is risking little by holding policy in place. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Nitin Dialdas, Chief Investment Officer at Mandarin Capital. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And please take a look at my website, which has a lot more business news from around Asia. You'll find that at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, the rally that propelled the major US indices to record highs this week stalled on Thursday. The benchmark S&P 500 gave up an early gain of as much as 1/3% to close 0.2% lower at 5,297. The Dow briefly jumped above 40,000 for the first time ever, but it closed 39 points or 0.1% lower at 39,869. The Dow has now soared nearly 40% from its low in September 2022 and more than doubled since the spring of 2020 when COVID-19 hit. The 30 stock index has risen about 6% this year. The tech-heavy Nasdaq Composite was down 1/3% at 16,698. Traders sold treasuries, pushing the yield on the 2-year note up 6 basis points to 4.8%, and the yield on the 10-year note rose 3 basis points to 4.38%. The US dollar was supported by the move higher in yields. The US dollar index climbed 0.2% to 104.5. The yen was the G10 underperformer, weakening 1/3% to 155.41 yen per dollar after data showed Japan's economy shrank in the first quarter. The offshore Chinese yuan slipped 0.1% above 7.22 renminbi per dollar after reaching its highest level in 2 weeks earlier in the session. The spot gold price settled 0.4% lower at $2,378 an ounce after hitting a mid-morning high of $2,397, close to a record high. Brent crude oil settled 0.6% higher at $83.27 a barrel. On the mainland, the Shanghai Composite rose 0.1% to 3,122. Markets in Hong Kong reopened after a holiday on Wednesday. Shares were buoyed by a rally in mainland Chinese companies listed in the city. The Hang Seng Index climbed 303 points, or 1.6%, to a more than 9-month high of 19,377. The Hang Seng Mainland Properties Index surged 4.9%, buoyed by reports that China's government was considering buying properties to convert them into public housing. And futures markets pointing to a gain of about 60 points or so for the Hang Seng at the open should start the day trading at around about 19,440. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's a Friday morning. Let's welcome our Happy Friday panel today. We have with us Francis Lun, the CEO of GEO Securities. Morning, Francis.
Good morning.
And also with us, Nitin Dialdas, who's Chief Investment Officer at Mandarin Capital. Morning, Nitin.
Good morning, Peter.
Let's start in Hong Kong, looking at the markets, shall we? As you heard there, the markets reopened after the holiday on Wednesday, buoyed by quite a big rally in mainland Chinese companies listed here in the city. The Hang Seng climbed 303 points, that's 1.6%, now at a more than 9-month high. And the Hang Seng has risen 9.1% so far this month, following a 7.4% jump in April. That makes it the world's best performing major stock index so far this year. Francis, how have we gone from being the worst performing index in the world to the best performing in just 2 months?
Well, I think it's just long overdue. We're just waiting for some good news, like good results from Tencent, but not so good for Alibaba. And then we saw the interest rate maybe falling down. The inflationary pressure in the U.S. eased a little bit. And also Chinese government launched some initiative, try to resolve the housing crisis, the property crisis. I think all these matters accumulated into a rally for the stock market, which is really down for almost 4 years already. So it's really, the rally is long overdue.
Nitin, it's still, despite this rally the last couple of months, I suppose we shouldn't look a gift horse in the mouth, but nevertheless, over the last 3 years or so, Hong Kong's really severely underperformed global markets, though, hasn't it?
Oh, yeah, it's very much a fair reflection of what's been going on in the Chinese economy, and Hong Kong is the barometer of what's going on there, and the market reflects that. So, as we all know, the last 4 or 5 years has been very tough for the Chinese economy, especially with COVID and the lockdowns, and they still haven't really fully recovered. We've got a number of numbers that are coming out today that will give us some indication on whether we're on the right track in China. But it's interesting though, because I remember back in March when some of the art fairs were going on, and there seemed to be a little buzz that returned into the city. And I commented to someone, I go, I feel a little buzz. And actually from that moment, we seem to have had the stock market going up. And I don't know if it's a reflection of that, whether it's the fact that people are now, hey, look, Hong Kong still is around. It's not, hasn't died, that people thought. Or is it just the fact that it is so cheap on a global scale as a market that it just makes sense? Or is there a dogs with a Dow theory going on with the global markets? There's a number of factors could be there.
Let me ask you then, Francis, specifically about this news on property stocks. There was a report in Bloomberg that China's State Council was going to get the local provinces to buy up these unsold homes at steep discounts, using loans offered by the state banks, and then sort of convert them into public housing. What do you make of that policy? It sounds like it's going to sort of convert a lot of companies into basically property companies, aren't they?
Yeah, well, all the local governments becomes property companies, and then the property developers will go extinct, because when you convert the luxury homes into public housing, you really trash the value of these luxury flats. And no property developer can make a profit if the end game is like that. I think the central government just does not want to pay out huge amounts of money, trillions and trillions of yuans, to bail out the property developers.
It's going to cost a fortune, isn't it,
Yeah,
if you have to do
definitely.
this all over the country?
Well, because according to some estimates, the unsold flats can house something like 1.4 trillion people.
Right.
People.
That's rather odd. 1.4 billion people.
1.4 billion.
Yeah, not
So
trillion.
Not trillion.
you can put another China or India into them.
Wow. Nitin, is this going to resolve the problems in the property market?
I'm actually not even sure what they're trying to achieve. If they literally trying to make it so that these properties are used, I guess then that solves it. But it doesn't solve the property market crisis. As Francis says, it brings prices down. And the big issue in China at the moment is people are feeling poorer and poorer. Now, if their value of property is going down, they're going to continue to feel poorer. So you're not necessarily going to get consumer sentiment rising out of it. You're not going to get sales rising out of retail sales rising out of it, and people feeling more confident to start spending in the economy. So, I mean, is it literally just to dry up the supply? But just accept you've got oversupply, figure out a better way. But what they're doing, it's just going to actually, to me, it's going to make it tougher for the consumers in China.
And also the property developers will be in effect bankrupts. Not that Beijing seems to care about that.
Well,
but
they
that
are
will
bankrupt. I mean,
this will just confirm it. won't
yeah,
it?
it just confirms what everyone knows, which they are bankrupt. For me, let's start at the problem that you've got many developers are bankrupt. Let them either go under, merge, start at that level, and then start working their way up the system. Yeah, there's probably going to be a number of replacement flats that are needed, but not enough to fill your whole population. And that's where it's got to be. Maybe you've got to convert some into hotels, maybe some into commercial spaces, some into industrial. But at the moment, it's just a massive crisis that I don't know how they solve.
Well, we also had earnings from two of our biggest companies, Tencent and Alibaba. Tencent, first of all, posted the fastest profit growth in 3 years, made $22 billion. That's a staggering amount of money, really, isn't it, for a gaming company? The adjusted net profit grew 62% year on year. That's the fastest since the first quarter of 2021. Is Tencent back on track?
Well, according to the figures, it tells everybody they are back in business. I think, after being suppressed by the state for so long, I think they are finally free to do whatever they want, and the result shows that they can achieve profit. But the problem is what can they do next? Because they don't have room to grow overseas, and the Chinese economy is hardly growing at all. Where can you find the growth bright spots?
Nitin, I mean, this is a very different company in many ways, isn't it, from where it was 3 years ago, or maybe in terms of its ambitions anyway. I mean, it still relies very heavily on gaming, but nevertheless, as Francis was saying, its global ambitions have been really curtailed, haven't they?
Yeah, they have, but I mean, I still think there are markets overseas that they can try and target, Southeast Asia being one. But I agree with Francis. I mean, you're limited in terms of how much full growth you can have. But again, it's been suppressed. So if the government continues to loosen the reins a bit, there is still potential growth internally. The question is what competitors come into the market too internally, and that's where they're going to have to face their problems. So they've got to be creative, and they've got to come up with different things rather than just gaming and WeChat, and see where they can go from there. But earnings were good, and that's always a positive. We always like good, strong earnings. It's a start, and it gives them potential to potentially grow. But yeah, they're not going to go to the US, are they, tomorrow?
Yeah, look at TikTok.
And Alibaba, not so good, was it? An 86% plunge in fourth quarter profit.
Yeah.
Now, they say that came primarily because of equity investments, and also it's been spending on sort of marketing to try and get back market share from firms like PDD Holdings. But what did you make of Alibaba's results?
I think the single biggest item is from their investment in the logistic company, which they wanted to list but bought at the very last moment. I think 3 billion yuan of write-off they had to do for their stocks. So Basically, I think the core business, like the Taobao, the online sales, is not really growing that much, and the other business not really fail to achieve high growth. So actually, Alibaba seems to have hit a big wall. I don't know how they can overcome it.
I wouldn't say I'm as negative on Alibaba as all that. I mean, revenue still grew 7%. Okay, it's not double-digit growth, it's not 20% growth on revenues, but it's still 7% growth on revenues. Now, the profit number, like you said, it's been there's been a few hits on investments. Write them down. I mean, at the end of the day, get whatever's bad out of your books and start again, because going forward, that means you can only have positive numbers as they return to normal margins. So I don't think it's as bad as people are making it out to be. I always tend to like to look at the revenue numbers more than, say, the net profit, because you can put a number of expenses into there, you can put a number of write-downs, but your revenue is really going to be reflective of where your business will go in the future, especially if you can create the profits out of it. So, as I said, I'm not as negative on Alibaba as, say, the market was, but let's see.
It's a company that's been completely put under the thumb, hasn't it, over the last 3 years, and really been completely had to change itself to cope with this new environment.
Mm-hmm. Yeah, it's due to Mr. Ma's big mouth.
Yeah, but what's interesting is they're rolling him out again, right? I mean, he's out there going, what was it, 4 months ago, saying he's starting to snap up some more Alibaba shares. He's being a little bit more of a face again. I find, like, the last 5 months in China very, very interesting, because a lot of the measures that they had put in place, handcuffing a lot of the companies, have been easing. Jack Ma's kind of now coming back into the market, or being a little bit of a face of Alibaba. So there seems to be a bit of a reversal going on. And as long as that continues, and as long as they allow certain freedoms to these companies, I actually only think it could be positive going forward for China.
The thing that's probably changed most for them is it had ambitions really to be a fintech company, didn't it? And to accelerate the growth of online banking. That's been completely sort of taken away from them. And as a result, China itself has suffered, hasn't it? Because, online banking isn't growing anywhere near as much as it could do in China.
Mm-hmm. Well, even though China leads the world in the online payment, but the fact is the state-owned commercial banks have their turfs to protect. They cannot let Alibaba and upstart to really completely clean the table. but the end result is that you have the financial system really stop growing completely. I think that is the sad part.
Mm-hmm. Nitin, it has affected the overall sort of fintech business on the mainland, really, hasn't it? Because Alibaba was going to be one of the biggest proponents of that.
Yeah, very much so. And, I mean, a number of factors there. As Francis alluded to, there's a number of state-owned banks that you don't necessarily want to see suffer. I think there's also control and visibility side of it. It's a lot easier if you own the banks to be visible on what's coming and going in terms of the monies. And yeah, they were never going to allow Ant to be what Ant could be. And as a result, it does affect the rest of the fintech sector, especially on the banking side. I mean, the payment side has always been strong in China, so it's not the entire fintech sector, but certainly within the banking side, it's suffering. And in that one, I don't think China cares. I think this is one where China's quite happy to retain control, because at least they get visibility on what's going on.
Okay, now on US markets, all the three major indices hit record highs this week. They did retreat a little bit overnight. The Dow was above 40,000 for the first time ever. This is a market that just seems unstoppable, doesn't it?
Yeah, defies gravity. I think they do have something going on for them. I think it is really the AI revolution. I think the Magnificent Seven, except for Tesla, I think they all, one way or the other, depends on the development of big high-tech business in artificial intelligence. I don't know how long this ride will continue. I think maybe at least for the balance of the year. I think maybe at the end of the year you need to take profit and take stock of what you have done. I think 40,000 is really a big plateau to reach, and then you will see some profit taking.
Nitin, what I find, I don't know whether it's odd or not, but we are seeing, aren't we, in the economic data, some clear signs now that the economy is slowing. In the US, we saw the retail sales data on Wednesday, which was poor. We had Philly Fed data overnight, which was poor. Weak home building activity, flat industrial production now in the data that came out today. But despite the weaker than expected CPI print, inflation is still running well above the Fed's target, isn't it? Well above 3%. Do you whiff the smell of stagflation in the air?
I think that it's really interesting because if we look at the markets themselves, the earnings have actually been very strong. It's been a pretty good quarter in terms of corporate earnings. So that's supporting the markets. You've got inflation, which is a problem. But the flip side is exactly what you just said. A lot of the economic numbers that are coming through are starting to weaken. So in terms of your question, do you start feeling a hint? Yeah, I do. I mean, I think you're starting to see first signs of the economy slowing down in a big way. But it's not yet being reflected in terms of corporate earnings, and that's what's keeping the markets relatively high. I disagree with Francis. I don't necessarily think it's going to last the whole year. I think probably come the summer, people will start taking stock. I think there'll be a redeployment of capital. I mean, the West has been getting a lot of the capital over the last 3-4 years, which is why we're seeing this run-up in the US. I think that starts getting redeployed into this side of the world. I mean, you just take the valuations. To me, 40,000 is just a number. Let's look at the PEs, let's look at the actual valuations, and that's where it's scary. I mean, these markets are running at really high PEs, and it's not, to me, I don't think it's justifiable. I mean, we've had the growth that's been relatively strong up to now. I don't think that growth continues. And with that growth not continuing, you can't justify the Ps where they are. And I think people start looking at that and start coming back. Or maybe I'm too much of a traditionalist and markets really have changed. But I really do think people start looking at the East where there's much better valuation.
Well, the markets really are taking the weakening economic data as good news at the moment. They're basically saying this gives the Fed more room to cut rates. And they're pricing in now 2 rate cuts this year, starting in September. But if you listen to all these Fed speakers that are being rolled out day after day, they're all saying the same message, aren't they? We don't see any reason to cut at the moment. We need to stay in restricted territory till we're much more confident that inflation's coming down. So once again, the market and the Fed are at odds with each other.
Yeah, definitely. I think the U.S. economy is still growing strong. They don't see demands weakening, and I think one of the key components of the core index is really the price of rental. I think the cost of rent has never come down this year. So I think it will be difficult for the inflation to fall to the 2% target level of the Fed. I think if you wait for inflation to fall to 2%, you might have to wait forever.
I mean, I think you look at this, unemployment rate is still below 4%. Corporate earnings are still strong. The Fed themselves are telling you we're going to keep them high for longer. It's just the market's so addicted to these low interest rates, they want them there. But if you take the economic picture as a whole, you've got interest rates at 5.25, you've got inflation at 3.4. That's probably a fair spread. In fact, probably, if you're being realistic, inflation should probably, the interest rates should probably be closer to 6 or even over 6 when you've got 3.4% inflation rate. So I don't think they've actually got that much room to cut, if at all. If anything, if they were running the economy properly, they probably should raise it another 0.25%, if not another 0.5%. But obviously, because the market's demanding the cut, they can't do anything. So they will just leave it flat until we do start really seeing inflation numbers go below 3%, until we see unemployment rates, say, start climbing above that 4% level, and we start seeing wage growths come down. And those are, to me, the major factors which they're going to look at. And the rest of it, retail sales, all the rest is just byproducts. But as long as unemployment's fine, wage growth remains high and inflation's high, they're not going to do anything with those rates.
Well, here in Asia as well, we've got markets at multi-year highs, some at all-time highs like Taiwan. The Taiwan weighted index closed at a new record high yesterday. But we have one big wild card here, don't we, which is Japan, because of the weak currency, their low interest rates and what that's doing on sort of macro policy throughout Asia. And the Bank of Japan's in a bit of a hole, isn't it? Because that GDP data that came out yesterday showed the economy contracted 2% in Q1, doesn't leave them very much room to go and raise interest rates at the moment. So presumably the yen is just going to continue to slide, isn't it? And that's going to impact currencies and markets around the region.
Yeah, definitely. Japan has a huge hole to climb out. But for Taiwan, it's really enjoying the best time of their economic history because their one company, TSM, which is really the valuation is bigger than their economy.
The whole market. I mean, people do worry a bit about that, don't they? That it's a great company, but it now so much dominates, first of all, the stock market, but also the economy in Taiwan as well. It's such an important part of the Taiwanese economy that, you know, if anything happens to TSMC, you know, it will bring the whole Taiwanese economy down with it.
Yeah, they're more important than the president of Taiwan.
As you said, the power of AI. I mean, it's that. Japan's an interesting case because inflation's running hot as well. So you can't really experiment, but I actually wonder if they did raise rates to a proper level, whether that would actually have a detrimental effect, given the fact that Japanese tend to be savers. Whether some of that money in their account, because they're actually getting some sort of interest, they might go out there and spend on the economy. Because at the moment, all they're relying on is the fact it's cheap yen and tourists are coming through, and that's the one sector in Japan that's performing okay. You've had a good rally in Tokyo properties and prices and things like that, but it's isolated. I mean, the overall economy, it's struggling, and I mean that's why you get this, the negative growth. But inflation's there, so you've got a massive problem. And so I wonder, as I said, I know they can't, but I do wonder whether it would be worth experimenting, putting up interest rates to what it should be, bear in mind where the inflation levels are, and seeing whether that savings start getting to work in the economy and people start spending.
It's an interesting thought, isn't it? It goes against normal economic policy, which is that, here you're saying raise rates and you may find inflation goes up with it. You're sort of like a reverse Turkey's president who says the opposite, isn't it? Cut rates and inflation will come down.
Yeah, exactly. I mean, I just think from an economic performance, where do you get the growth? You've got demographics that are terrible. They're not exactly attracting people from overseas to come and work in Japan, outside of, say, again, certain pockets. Yes, you've got tourists coming in, but where else do you get your growth? How do you get your growth? How do you get things back on an even keel? At this point, I mean, as I said, is it worth it? I keep saying they won't do it, but I just keep wondering whether it is worth the experiment or not.
Just bite the bullet and normalise rates,
exactly.
And maybe that will help. I mean, the household spending was pretty weak in that GDP number, down 0.7%. That's the big part of the problem, isn't it?
Exactly, and that is exactly it. And how do you get them to spend if they're not? They're purely relying on their earnings, and their earnings, they always will put part of it for savings. So if they don't necessarily need to put all that in savings because they're getting extra income from their savings, that much more could go into the economy. But it's not the conventional way of thinking, unfortunately. So
let's talk politics for a little bit, shall we? President Xi Jinping welcomed President Vladimir Putin of Russia to Beijing yesterday. It's a 2-day state visit. Vladimir Putin's first foreign trip since he began his 5th term in office last week. President Xi, he was basically touting this economic relationship. He says it's going to last for generations to come. He's ready to work with Russia as a good neighbour, friend and trusted partner. What I want, I mean, I can totally get what President Putin gets from this relationship, but what does China get from it? What does President Xi get from this?
Well, Russia is the only friend that China has in the world among the major countries.
Is that what it's about? It's about having friends?
Definitely, because China, Russia, Iran are the outcasts of the world.
So why is he doing this? Because it comes at a heavy price, doesn't it? It's really costing China's relationship with the EU in particular.
EU and the US.
As long as it keeps supporting Russia and providing, funding for its war in Ukraine, then it can't be friends with the EU. The two are just incompatible, aren't they?
Of course, and if you don't have any other friends, you have no choice. I think that is the problem for China.
This comes with big risks, doesn't it? I mean, we could find that if he allows Russia to start accessing the Chinese financial system, and which he wants to do because he needs to pay for things in yuan, he can't pay for them in US dollars. We could find the Chinese banks being sanctioned, having secondary sanctions put on them, which would be pretty tough for China's financial system.
I agree, Francis. It's very much about creating friends, and they need friends. At the same time, I think China does feel US is trying to bully it, which they are, because US feels threatened, right? I mean, if we're going to go through this whole thing, US feels threatened over the fact that China was going to become have a larger GDP than it. So they've done everything in their power to try and suppress the China side of it. Now you've got allies there that don't like the US just as much as you don't like the US, or I wouldn't say they don't like the US, because I think China would like to have some sort of play in the US, but the fact the US is bullying them, you've got to find allies. So Russia's an easy ally because of what's going on. In terms of whether it's a risk, yes, it's a big risk because EU will have certain issues. But let's not forget money talks. We could look at Saudi Arabia as a great example. I mean, wasn't it 6-7 years ago when the whole Khashoggi affair, where everyone's starting slams to Saudi Arabia? Now everyone's trying to grab hold and get some of that Saudi money. Unfortunately, that is what talks in this world. So as long as China plays a role and they can help the EU economy, I think they will temper their vitriol against China with what's going on, because EU has been the basket case of the world over the last 10 years economically. They need economic growth. They need things to start going back on keel and have things going back on track. China can play a big role in that, especially given the fact that Chinese like to consume European goods. So I don't think it's going to be as risky as maybe one thinks, because ultimately I do think money talks, and your economy is a big part of your play. But China's got to find the allies. I know they're not going to get it from the US given where they are. EU tends to try and tie themselves to the US because of historical relationships. So where do you find them? You've got to find them within your region, and they will go around the region, and they've got other allies in the region too, apart from Russia. They also have a lot of enemies like Philippines, but that they're trying to build that kind of relationship, and it's that battle. It's them and us, US, the West against the East, and I think that's what they're going to try and go towards.
And this is about, they want to change between them the global world order, don't they? Correct. That's what drives them together ultimately.
US has been driving that, and US rhetoric has been driving it. US controls the media, so that media is the media that we read anyway. So that's been driving a lot of it. So they want to fight back, and they've got to fight back because, a lot of the brushes that US tarnishes China over, US are 10 times more guilty of, but because we read it and in the press, we only look at the China side of it. So I think they're right to try and fight back. Whether allying with Russia is the right way, that's subject to everyone's thoughts. But they have to find something, and I think growing a global alliance around them, or some sort of regional alliance around them, I think that strengthens their power, their position in that fight.
Francis, what do you make of this US move to raise tariffs on $18 billion of imports, including semiconductors, electric vehicles, where they're going to quadruple from 25% to 100%?
Well, they know that they lost the race to make the electric car, electric vehicle. So they want to forestall the entry of Chinese-made EVs into the U.S., which would have crushed the big three, because China can make a electric car at $10,000 US, and American manufacturers can make a US electric car at $40,000 US. So there's no competition. So if you cannot compete, well, bar them. I think that is really the rationale.
So it's just protectionism, but
Definitely.
it's just raw protectionism.
Yeah, raw protectionism, nothing else.
Completely. You go back to 40 years, Japanese cars were initially in that position, and then in the past, US welcomed innovation, they welcomed competition because that was the way they were going to improve. But the way they could have done it was, okay, well, you've got to have your factories in America, so at least you don't hurt the employment situation. Here, I think this protectionism, this lack of allowing stuff to come in the long run, it hurts America and actually strengthens those other markets because you're forcing the other markets to be more competitive, you're forcing the other markets to be more innovative by not entering that market, right? So, because they'll compete in the rest of the world. And I think it's ultimately going to hurt the US, but, you know.
Well, we learned that, didn't we, when they put tariffs on Japanese cars, when was it, 20, 30 years ago? Yeah. It didn't make the American car manufacturers any better. All that happened was Toyota became the world's biggest car company. Aren't we going to see the same thing again here? This is not going to make American EV manufacturers any more competitive at all.
Yeah, exactly. And, you know, in the end, Toyota started building factories around US, and that's what I mean. That's your better option, is go back, learn from history and tell Chinese automakers, okay, we'll have so much tax on cars come in from China, but if you make them in America, we don't have that anymore. So they're still Chinese manufactured cars per se, in the sense that the Chinese innovation, Chinese technology, but you've got the employment being made in America, so it's a win-win, and it doesn't hurt your inflation as well, because ultimately all of these tariffs, whether it's only on $18 billion worth of goods or whatever, all of this is going to hurt your inflation side, and that's actually the one thing you're trying to control at the moment. So it's all very hypocritical.
Francis, this is sort of the difference, isn't it, between the US and the EU here? The EU does and has made it clear it welcomes Chinese investment. It wants their car manufacturers to open plants in Europe. BYD's opening a big one in Hungary. It's not so clear to me that the US would welcome Chinese car manufacturers setting up plants.
Yeah, definitely. I think BMW sells all its i3s. They were all manufactured in China. Even the i3 BMW by in Hong Kong is made in China. So the EU has much more experience working with Chinese manufacturers. In fact, many of the Chinese car manufacturers are setting up or will be setting up factories in Hungary, Spain, and also Italy, and also battery factories everywhere in Europe. So it's difficult for EU for impose a punitive tariff on Chinese EV manufacturers. I think it's much more complicated than that. The US just keeps Chinese manufacturer out, no matter the cost. But EU is a different story.
Okay, well, thank you both very much. Have a great weekend. You heard there Francis Lun, who is the CEO of GEO Securities, and Nitin Dialdas, who's Chief Investment Officer at Mandarin Capital.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Yeah, good morning, Peter.
Now, Australia's government announced its annual budget late Tuesday. What were the highlights of that?
So the highlight, I guess, is firstly a $9.3 billion surplus. Very few countries, I think, can claim a fiscal surplus in the current climate. Although, in a sense, it's a bit of a misnomer because the following 4 years we'll get about $112 billion of deficits. So one of the reasons we've been able to get surpluses in Australia has been the higher prices for commodities, iron ore and coal in particular, versus what the budget expectation of the prices have been. And that's likely to have a less impact over going forward. Plus the government's increased its spending quite dramatically, something in the order of $24 billion we'll spend over the next 4 years. A lot of the budget was designed around cost of living due to higher interest rates, due to higher inflation and higher prices. The government spent a lot of money handing back some money to just about everyone. In fact, every taxpayer will get a $300 rebate on their electricity bills. So it's very much a political stunt more than anything, but very handy for those who are struggling with higher electricity prices. So there's some of the main things. But overall, from a market's perspective, it was really about the view that despite the $24 billion of spending and the 4% overall spending in the budget increase, the Treasurer claims it'll be anti-inflationary or at least disinflationary, and that's a bit of a miracle play, I think, that the market's not quite buying.
Yeah, and presumably the Reserve Bank of Australia is not going to buy it either.
Well, that's going to be the interesting thing, and I'm pretty certain that they won't. The one thing that there's a lot of tricks in every budget, and I'm sure, listeners don't want to go through all the details of a budget, but there's always hidden bits and pieces here and there. The bottom line is it is an inflationary budget. Notionally, because of the rebates that they're going to put in, that you'll get a measured inflation on headline come down, and that's an argument politically, but it won't convince the RBA to cut rates any sooner, that's for sure.
Are there concerns about the fact that, although, as you say, there was a budget surplus this year, that you are going to see quite wide deficits in the next sort of couple of years? Are there any concerns that maybe, what the government should be doing is sort of reining in spending rather than adding even more handouts?
Yeah, and I think it's a fair argument, particularly if you actually look a little deeper. The government claims it's only increasing spending by 1.4% over the period, but that's discounting all of the off-balance sheet spending. So the one which they account for spending on projects that are investments, they don't take them into the P&L. Then that's increased from 30 billion to 80 billion. So for those who are students of economics and students of accounting, we'll see that the off-balance sheet items have grown dramatically, which means spending has gone up, and so any fiscal restraint that could be perceived with that surplus of 9.3 billion really doesn't exist.
And I presume
high spending budget.
I presume this budget was also designed with the fact that there's going to be an election in a year's time. That was in mind as well.
Totally, yeah. No, it's definitely a pre-election budget because we know that the government has to go to the polls by May next year, but at this time next year. So if they go, they won't probably want to have another budget going into that. So this is the one that they want to do. And also, and again, for the purists, there's a contingency amount sitting in the budget, which is another 20 odd billion, which is where they'll hand out some more pork in the lead up to an election. So, I mean, both sides do it. It's not a statement on the current government. All governments do it to try to maximise the chances of being re-elected. But to your point, it is an unrestrained spending which will concern not only the RBA, but will concern the IMF and others and credit ratings in relation to Australia's control of its debt position, which is growing quite substantially.
And how is the economy doing? You had some unemployment data, I think, earlier this week as well, didn't you? What was that showing?
Well, that showed a surprising increase. So the forecast was for 3.9% unemployment. It got to 4.1%. For those, again, who are purists, the non-accelerating inflation rate of unemployment that the RBA thinks is necessary to impact inflation will be 4.5%. So at this stage, that's the target sort of going forward that the RBA are seeing where they'll need to see unemployment get to. So it was interesting. The spike, albeit negative from an unemployment perspective, was good for the market because it suggests that they're heading towards that, which might mean that the Reserve Bank are more amenable to rate cuts this year rather than forecast for next year. But the employment data series is really, it's a labour force survey and it's a very volatile series because if you look in deeper, we actually saw an increase of 38,000 in employment in the month and the unemployment rate rose because of the participation rate. So when you look at these numbers, you've got to take them at face value. I suspect the labour market's still too tight for the Reserve Bank to pivot.
And how has the Australian stock market reacted both to what's going on domestically and also internationally as well, where markets in other parts of the world have been soaring to record highs? How is Australia doing in comparison? Yeah,
similarly, Peter, the Australian market had a very good day yesterday on the back of the CPI figures out of the US. Record highs in US stock markets. That's feeding through. And likely to continue, at least in terms of relative moves. Overall, I think the Australian market, the Australian economy is still performing. It's going to be subpar growth, sort of sub 2%. So it's hardly exciting, but investors are still pretty comfortable to hold stocks.
Internationally, the US stocks at record highs. The Dow rose briefly above 40,000 overnight. Seems to be coming, though, as the economic data is cooling, isn't it? We had the CPI print, which was a bit lower than expected, but pretty dismal retail sales data. We had weak home building activity. Last night, the flat industrial production report, Philly Fed data wasn't that great either. There seems to be more and more signs that the economy is starting to slow.
Yeah, I think that's true, and hence equity markets are rallying. So slightly counterintuitive because they see that interest rates will come off, so the Fed will move. So at the moment, you're looking at in terms of futures markets, a 75% chance of a cut in September and a 70% chance of 2 cuts by the end of the year. So that's obviously seen interest rate markets, the bond market yields have dropped handsomely, and that obviously is a good thing for stocks. So on the one hand, you would think that negative economic news would be negative for stocks. It's actually positive because of the interest rate story. On the retail sales, you saw 7 of 13 sectors post declines in activity, so that's clear that there is softening. And on the CPI, there was definitely a pullback on the CPI, but the PPI earlier in the week was slightly higher than expected. So again, month-to-month series has got to be really careful to draw too much inference. But I would suspect that the Fed are a little happier this week than last week when it comes to its dot plot on rates.
But if you listen to those Fed speakers that have been wheeled out this week, they're all saying the same thing, aren't they? Despite the markets pricing in 2 rate cuts this year, starting in September, they're saying, we need more evidence that inflation is actually coming down. That number is still too high, and they seem to be repeating that same mantra. Yeah,
it's the sort of last mile scenario that seems to be hitting the lingo now. This last mile of inflation is taking longer than forecast. And I think this is the Fed managing expectations. They don't want the market to get too ahead of itself because, as we just said, the month-to-month series can be volatile, and it'd be hard to want the market to start inferring things from one set of numbers. So I think they're just tempering the view not to create too much expectation. Albeit I agree with you in your first comment that the economy is definitely showing signs of slowing, albeit in such a way that the labour market still stays tight and corporate profits are still reasonably strong across the board. So, on that basis, investors are still fairly comfortable holding equities as reflected in the record highs for the Dow and S&P and NASDAQ.
And what about in Europe? The European markets all hit record highs as well. The Stoxx 600, the FTSE, the CAC 40 in Paris, they all hit record highs. I presume that's partly because there may be a sense that the ECB and maybe even the Bank of England are ready to move on rate cuts fairly soon.
Yeah, the forecast, I think, for ECB and Bank of England is probably June more than September. So that would be partly the reason. There's a bit of a technical element to it. We saw a slight pullback in stocks, which probably wasn't as deep as we had expected and deep as what many investors had hoped. So missing that move, at least hoping for a bigger pullback, means they might have chased in on the break back up. And if you look at the technical charts across most of these major indices, they're fairly constructive for new highs or further highs. And I suspect what happened is that a lot of investors have been sitting on the sideline waiting for this pullback to happen. It just didn't get deep enough. So I think a few of sort of bit of FOMO jumped in, and that's reflective of what's happening in Europe. Europe's obviously a little ahead of the curve when it comes to interest rate cuts. So that's probably a good sign that their equity market's responding to that.
And here in Asia, we've got markets multi-year highs anyway, although Taiwan did hit a record high last night. But it seems to be the big elephant in the room here is Japan, isn't it? Very low interest rates, the currency sliding. That seems to be having a very big macro sort of economic impact around the region, and particularly with that GDP data we saw yesterday, down 2% from a year ago. It seems that the Bank of Japan is going to struggle to raise rates.
Yeah, they did indicate in their meeting last week that they were open to the possibility. So they've got a little bit of a tough ride. The domestic economy slowing, currencies depreciating. How much of a contagion impact on the region, I'm not sure. at this stage whether it has as much impact as, say, a China story. If growth continues to sort of perform subpar in China, it'll probably have a much greater impact on sentiment in the region than Japan. But it is an interesting challenge for the Bank of Japan and for the Japanese government on maintaining velocity in their economy and avoiding a disinflationary environment. But it seems like they're struggling to get that acceleration now, and maybe they've hit a bit of a peak. And the market, maybe in the pricing of the yen, has been reflective of that.
And there is a sort of unusual economic theory, we were talking about it a little bit earlier on the show today, that maybe what the Bank of Japan should do to get inflation up is to actually go and raise interest rates. I know that goes against normal economic orthodoxy, but maybe that's what it needs, a normalisation of rates, because Japanese people are big savers. They would then start going out and maybe spending more.
Yeah, there's an interesting theory around that, is that, because you've got to create expectation. So often by doing something counterintuitive, you get a bigger response. And you're right. I think they need growth and velocity as much as anything. What they don't want is to grind back into a recessionary environment. So in order to maintain that, they can probably wear inflation for a bit longer, which I think has sort of been part of their strategy, right, to try to get some velocity. So on that basis, actually hiking rates might work, and it's not completely abnormal in terms of policy making.
Okay, well, thank you very much. Have a great weekend. You heard there Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Lashar, Asia Chief Economist at BBVA. And providing a view from mainland China will be Shanghai-based independent economist Andy Share. Have a great weekend.
Money Talk.